In this video, we'll be looking at gross profit margin and net profit margin. Gross profit margin. So the first question is, why would you want to calculate gross profit margin? Generally speaking, the idea here is to understand a company's product's contribution to its business. So how much company is spending on cost of goods sold to generate revenue. The idea here is to use this information once it's calculated, compare it with your competitors, or if you're an investor, you might want to compare different companies and see which one is more efficiently generating revenue without having a lot of cost of goods. Another thing that you might want to note in this particular case is that when you're calculating gross profit margin, it ignores things such as interest, taxes, depreciation, amortization. They're not included in it. So how do we calculate this? To calculate, click in C6 equals, open parentheses, sales revenue, which is in C3, minus COGS, cost of goods sold, which is in C4, close the parentheses, divided by C3, which is the sales revenue, hit enter. In this particular case, the answer is 56%. So that's relatively a good number. But again, the idea here is to compare with other competitors, or maybe compare your products internally and try to apply it on different products or different departments and see how one is better than the other one, or why does one have more cost of goods sold compared to another department or another product. You get the idea. The next one that I'm going to look at is the net profit margin. To calculate net profit margin, click in C18 equals, open the parentheses, we subtract all these costs, so cost of goods sold, tax, interest, depreciation, amortization, we subtract it by sales revenue. To do this, you first have to open the parentheses, give the reference to sales revenue, which is C11, and then you hit subtract sign, another open parentheses. Sorry, before that we put in sum of all these costs, close the parentheses, another parenthesis to close the initial one, and then divide this by the sales revenue and hit enter. In this particular case, we have net profit margin of 29.56% after taking out all the costs. And again, the idea here is to analyze your different products or efficiency for different departments if you can. Another thing that you can do with net profit margin is to analyze different line items here. So depreciation, maybe you want to compare it with previous periods within your company, the interest of how it has gone up or how it has gone down, and you might want to think about things if there's new machinery, or if there's more property, or if you're taking out a bigger loan. All these items need to be taken into consideration when you're doing your variance analysis. In a nutshell, both of these tools are very powerful, very easy to use, and the idea here should be to generally grasp the idea behind these two ratios and analyze them in various situations which I might not even have covered here.